Now, I'm sure as I'm preparing this video, hundreds of other people are making similar videos discussing Kevin's recent decision to sell his entire stock market portfolio. Now, just to get this out there, this isn't a bashing Kevin video. He has a great following, makes interesting content, and is somebody who I do fairly regularly watch. Perhaps not being a decision and instead forced with him being margin called are clearly shocking, but we will address these in due course. Also, there are a few points which he made in his video which I also do fundamentally disagree with, but again, we will address those as part of this video. Now, when it comes down to it, I have a very different approach to him in my investing, but credit to the guy for building a net worth which he has through investing. And I've worked in full-time investing related jobs, whether that's investment banking or private equity, for nearly 10 years now. So the weekend just gone, Kevin announced that he was selling his entire investment portfolio, basically all of his stocks and all of his crypto, around $20 million worth. Now, I'm not going to lie, I was very shocked by this, as I have seen until recently Kevin establishing new positions in various high growth stocks, those with the highest beta and like to get slammed the hardest in a market correction. Now, I do share Kevin's latest mindset that the market will be tough over the next few months, and I will go into the exact macroeconomic indicators that have drawn me to this conclusion, but it's not because of the rate hike that potentially is coming later this month. The market has already to some degree priced in these rate hikes, and so I don't see an acceleration of that schedule as anything overly meaningful. Where Kevin and I do really differ though, is that I've been rationalising and decreasing my positions for a number of months now, not establishing new positions like he has been. I've also been making sure that the stocks which I do hold are those which are best positioned in the market to weather a storm, and ones which are supported by long-term underlying growth dynamics. As part of this, I've also been building my cash reserves and positioning myself to capitalise on the correction and dip when it comes. Now, we've not seen a proper dip yet. This is still just part of a broader equity market rotation. Kevin, on the other hand, has been seeing recent decreases in the stock price, and some tech stocks especially, as the dip which should be bought, and he has been doing so. Now, for the avoidance of doubt, I don't think we're there yet, and I think there's still more pain to come, but I will explain exactly why I think that in a moment. So, why is Kevin all of a sudden selling? Now, there are rumours circulating online and on Reddit that perhaps he's been margin called, and I have no way of validating or falsifying this if he does indeed still trade with margin, but of course that could be a probability. However, perhaps he's just had a change of heart, is accepting some losses on some recent investments, and does believe there's a rough ride for the equity market over the coming months. I do wonder how long before we see rumours of him trying to capitalise on his enormous following and to create more fear in the market and help his short positions he now has on the market. I'm guessing a rumour like that isn't too far off. Now, personally, I do think such a sudden and drastic U-turn is unusual, but clearly Kevin is not a professional stock market guy or an equity investing guy. Whilst he's clearly enormously successful in real estate investing, he's not got the same expertise and pedigree in equity markets, and perhaps maybe faced with more information, he's just changed his tune. Personally, I'm of the belief that we've not seen any proper stock market correction yet. Now, I am going to get a little more technical here, but hang in with me. What we've predominantly seen is a sector rotation, with investors reallocating capital from growth stocks to value stocks. This makes sense when there are concerns that inflation is high in the market, as future earnings by companies will be worth less. Now, growth stocks have more of their future cash flows generated in the future, and so therefore are valued less in a higher inflationary environment. Now, you may hear these stocks being referred to as high beta stocks. Beta is a measure of the volatility of that stock versus the broader market. A beta of less than 1 implies that the stock market moves less than the overall market, both positively and negatively. A beta of 1 is exactly in line with the market, whereas a beta of greater than 1 is one which moves more than the overall market, either positively or negatively. Growth stocks are the higher beta stocks, or those with a beta of greater than 1. When there is a bearish sentiment in the market, as there is currently, there's a flow of capital to the more resilient, lower beta stocks, and that's what we've seen so far. What we've not really seen yet on any meaningful scale is the withdrawal and extraction of capital from the equity markets overall. We've seen trickles of it, and arguments that the interest rate hikes planned are already priced in, but on an aggregated level, this is just a sector rotation. My belief is in March, when we see the first rate hike, is the time by which we will have seen more capital leaving the market and going into other asset classes. And this is all just part of the normal business cycle, and this is why I'm much more bearish for the markets in the months leading up to this and the couple of months preceding this. We are seeing an increase in the amount of fear, uncertainty and panic creep into the market. And this will continue, mark my words, and there'll be many more red days to come. Sadly, I've lived through this and invested through this before. I'm also of the belief that this concern about inflation will actually be allayed much quicker than the market is currently pricing in. Now I will cover this in explicit detail in a separate video entirely, where I'll go through all my evidence and data that explains why I'm coming out to that conclusion. However, should I be right, on the back of this, there's a decrease in the concern about inflation and interest rates, and then capital flows back into the higher beta growth stocks. Now I have been saying for some time, over the last 6 months as the inflation narrative started and grew, that I was focusing on rationalising my positions, decreasing the diversification in my portfolio and making sure that my positions are only in the stocks which I have the highest degree of confidence in and which are underpinned by long-term growth dynamics and an underlying robust thesis. I haven't been establishing new positions. Instead, I'm waiting to see this correction and dip play out. I want to see the market bottom out before establishing any new positions. And I certainly don't want to be catching a falling knife, as that is never a good situation. However, when we hit that bottom, the market will still be very fearful, and that is where the cliche which you've all heard comes into play. Be greedy when others are fearful. Now, one final thing for this video is that I do fundamentally disagree with something Kevin mentioned in his video. Something along the lines of, if you invest at the peak of the market, as long as you hodl, you'll be okay in the end. And I think the statistic was something along the lines of, if you hold for 14 years, you'll make your money back. Now, when it comes down to it, I'm not a believer in this mindset at all. Firstly, if a company is not a good one, then it should be ditched. If you made an error in your assessment, or something fundamentally changes, then that capital can better be deployed in another opportunity. Cut your losses. What this statistic also ignores is that there is survivorship bias. Whilst on an aggregated level, yes, this may be true, when looking at the components of an index or the companies which form part of that, that's not static over time. Companies may fall out of it, potentially disappearing entirely, going bankrupt, getting acquired, or just getting smaller and trading on a smaller market, and they're replaced with other companies. In those instances, if you had invested in one of those companies that had fallen out of the index and say gone bankrupt, you as an investor would never have made your capital back. Personally, that's why I would not suggest this as a sensible strategy if the stocks you hold are not ones that you have a strong level of conviction in. Anyway, that's it for this video. I hope you enjoyed it. If you did, please smash the like button and subscribe if you aren't already, and check out the Patreon for the private Discord and other investing related content. As always, please let me know your thoughts and comments in the comment section below. I find it so interesting to hear all different opinions and perspectives, so please get involved. Thanks again for watching, and I'll see you in another video.